What do you guys think is going on with the real estate market, right? Like, I mean, what is going on with rates? What is going on with housing, inventory?
Yeah, not great news there. And with that, not as many people are looking to move.
Have some a rough time. Not that I'm wishing that on anyone, but like, let's face it, man. Homeboy has been at the top, living the literal dream of everyone for like 20 plus years.
The reality is, like, the housing market is very predictable in the sense of people don't always move and people don't always buy houses until they're ready to move and ready to buy a house, right? Like, they take a pause.
You can spend it without it being traced or without being asked about it. But John nailed it right there. Taxes.
You're taking a big, fucking gamble on people.
All right, everyone, this is Brian Coester with Real Estate Connection, and we are going to do another show of Wrecking It. Today I've got Fritz Schaper, as you know, and Jon Harnish, who's joining us today. And welcome, guys. How's everything?
Good.
How are you doing?
Good. So we've been talking about some stuff, but first and foremost, what do you guys think is going on with the real estate market, right? Like, I mean, what is going on with rates? What is going on with housing, inventory? I mean, it has just been bananas with the announcements, the stock prices, all that stuff. What are you seeing, John?
We saw a little drop in the rates there for I think it was a day or two right before the midterms, and then I think it's gone basically back up, still in the mid to high sixes range if you're going with a government loan. Not great news there. And with that, not as many people are looking to move, because if you have to sell your house, you're gonna have a new place to live. And then you're gonna have a higher interest rate. So not a lot of inventory, it looks like.
Yeah, and that's true, right? So, like, if you're moving, if you already have a house, are you going to give up your 3% interest rate to then go buy another house? I mean, even if you have equity, there's just an element of, like, anyone who's moved in multiple houses, you recognize real quick, like, there's not a big difference between living in a townhouse and a single family house and a 3,000 square foot house and a 10,000 square foot house. I mean, it's just, there's not a huge difference, right? So it's like, will people give that up?
Right. Yeah. And that's, kind of speak to your point. It's, what is it? It's like after X amount of days, you feel the exact same as you did before whatever big life event happened.
Correct.
It kind of goes the same thing with the housing and I think, especially a lot of the more experienced homeowners, why am I going to give up this lower rate, lower payment, have to spend money on a down payment, go through the hassle of moving, and it's a pain, especially right now in the winter on top of it.
Yeah.
We're in the historically November, December, the slow, this November, December, January, this is the slowest months in the industry anyway, right? In the housing, typically, because it's winter, holidays, New Year, all that stuff. Combine that with, again, the rates going way up and a lack of inventory based on the fact that people are not willing to sell at this point, and their new building has pretty much stopped effectively. New construction is very, very slow. And this is what you end up with. You end up with a slow housing market, which is what we have right now.
Well, and the housing market too is, like, generally really inefficient, right? And it's interesting because people always talk about, like, the booms and busts of the housing market. But, like, the reality is, like, the housing market is very predictable in the sense of people don't always move and people don't always buy houses until they're ready to move and ready to buy a house, right? Like, they take a pause and they watch things and they let pricing sort of adjust itself. But it takes a long time, right? I mean, it's not like something that happens in the stock market where all of a sudden you see, an announcement come out that, like we were talking about crypto, right? Like, all these crypto companies are just, right? Like, some announcement comes out that, some quote from Warren Buffett or something like that comes out, and all of a sudden crypto hits the shit, and, the stock market overnight loses $1 billion. Like with real estate, I mean, it's months of, prices being reduced, interest rates, buyers, looking at the properties, coming back and saying, no, it's not really a really good fit. And then, prices being reduced again after they feel the pinch, the sellers coming to realizations like, hey, I've got some equity, but not that much or not as much as I thought. And I'm going to have to lower my price and my dream about this. And is it really worth it? And it's tremendously inefficient, right? And they always used to joke, like in the appraisal business, that you're making like, really current or even forecasted valuations based on like very old data, like data from a year ago, data from 6 months ago. But the reality is like the market moves at that kind of pace. And I think you're seeing now is everyone just being like, all right, I'm taking a break. And mortgage lenders aren't set up for that, right? So, I mean, John, on your side of the fence, you guys are in a good position, but I mean, there's some bloodbaths going on. Let's talk about that. Like, how are lenders doing?
Yeah, I mean, I know we do a lot of purchases, and at the end of the day, there's still going to be more. People are always going to want to buy homes. Not that they always can, but people always want to buy homes. But probably one of the bigger shifts I'm seeing actually is, it sounds silly, but when we run DU on for the buyers, now we're seeing all of a sudden getting a gift is switching their so if they're getting a gift from a friend or whatever, it's taking that approve eligible and it's making it a refer. And I mean, that can really just fuck everything up, especially if you have a higher debt to income ratio and it works, now all of a sudden it's a refer. I mean, it kills deals. And that's one of the bigger things I'm seeing. And I don't know, how much it's something, that is controlled or how much there is, but that's one thing I've been seeing a lot of, is, with the market right now, where some of the bigger investors more, just tightening up on that end, if that makes sense.
Yeah. And, I think that's what you're going to see though, right? I mean, Amazon announced they're laying off a bunch of people. Wells Fargo announced they're laying off a bunch of people. Interest rates are on the rise. And then the lenders kind of know what's coming, right? Like these guys are smart, right? I mean, it seems like I always look at what the big banks and the big investors are doing because like there's a reason they're doing it and they get notice like way ahead of time, right? Like Wells Fargo gets like months ahead of time notice of information. But, I do think the mortgage market was just blowing and going. And by nature, I mean, it just was unsustainable. And you're going through that correction period.
Yeah, it's got to slow down. It couldn't have kept going at that rate either. Yeah, no, especially as everything kept increasing as far as like the values go. I know where we ended up buying it, in a matter of 3-4 years, the values almost doubled, and that just doesn't sound right at all.
Yeah, no, it's not, and it's certainly not sustainable. But one of the things that's happening too that is big, that's now coming back, that's been missing for a number of years, because we've had historically low interest rates for really nearly a decade. Okay.
Yep.
And so now what's happened is now that there's been corrections, and the Fed, to their credit, was very upfront about the fact that they announced well in advance, hey, we're going to do all these interest rate hikes. We're going to do them systemically. We're going to spread them over a period of time. So as far as rates going up, guess what? They're still going to go up because the Fed has not backed off their plan to continue to hike these rates. They've come down a little bit recently based on better than expected inflation numbers, which is offset by by the employment numbers. Again, better than expected, better than anticipated. That's why the rates went down shortly before the midterms. People think there's some conspiracy to it. It's not a conspiracy. It's very simple. Inflation slowed. It dropped down to about 7% from over 8%. And as a result of that, the Fed, there was a correction and the rates went down. That's, This is to be expected. But one of the things that's happening now is you've got much larger banks and the big players in wholesale, and all of a sudden they're focusing on buy downs. And buy downs are not something that we've seen in wholesale in a decade. That has not been a popular option in the last 10 years with the rates being at historic lows. But now that the rates are going back up, this is where the lenders are now focusing, is on those buy downs, because they can make their money up front on that loan. And then at the same time, the buyer gets the benefit of the lower rate because they're paying for it up front.
Yeah. And do you think, I mean, are people taking those, right? Like, are people taking those buy downs, or is that, because most people, when they're buying a house, don't even have the cash to buy the house, right? I mean, from what I've seen, very few people.
Right. Like John was talking about, we've seen all these gift funds now being added, right? That
are coming in with 20%, or even people who have money, and they're going to buy a house, for $700,000-$800,000. I mean, they're not coming in with 20% down, right? Like, I see, like,
if they've got 20% down, they're buying that house.
They're coming in with cash, and they've just got a ton of money, and they're just like, here you go, get out of my way. Or they're like 5-10% down, right? 3-5-10%, and they're squeezing that down payment out. I don't know. What do you see, John? Do you think the buy down thing is that just a marketing thing? Do you think that's going to be long term?
Yeah, I think it's more just marketing to try to entice people.
Okay.
To keep buying homes. Like, don't worry about the rates, they'll come back down. Most times it at the most we'll see depending on the amount of concessions that they're getting, but because people are so close with the cash, and when we're trying to make the file work, it doesn't necessarily make sense, and it's not going to save them a whole bunch on their monthly payment anyway. So you're paying more up front, most likely, if it's coming out of your pocket or you didn't get concessions. It's not going to save you a whole shit ton for how much you're going to have to come out of pocket for it. And it's like, man, why?
Yeah, so I'm going to pull that up. I'm going to pull
where the rates are right now.
Yeah, I'm going to pull that up real quick. So here's an example of a buy down. So conventional buy down, 20% down on a $400,000 loan. You get a 3.25% interest rate, and then 5.29% APR, and then the payment would be $2,300 a month. Second year payment $25,000, and then the third year, assuming interest rates are the same, $2,700. So you're going to save like $200 a month, right? Yeah. So that's not a big.
Yeah, well, not for how much you'd have to put down for it.
Yeah, I don't. By $8,000, $8,500. Yeah, so you're not really saving. So if you put up $8,500, you would save approximately $200 or $300 a month in that 2-year period. But then it would go back up. So what's the point?
Right.
The only hope is that interest rates would be lower later on, so you could refi. But that's
well, but then you're adding you're adding the cost of the refi too.
Well, right? I always tell people that cost to refi. Like, I always tell people with home ownership, like, the interest rates really don't mean that much, because at the end of the day, it's really your payment. Right. I mean, it's like with money, with, asset allocation, right? If you're spending $2,000 a month and it's going to rent, and then all of a sudden you're spending $2,000 a month and it's going, portion of it's going to you, portion of it's going to the mortgage company as interest. I mean, that's really the difference. And then if you have a 6% interest rate or a 7% interest rate or 3% interest rate, I mean, they're all really low interest rates, and the cost of the taxes on the house, the HOA, the condo, the insurance, the maintenance of the house, the utility bills are all going to be the same, right? So, like, you might have plus or minus, a couple $100 here or there based on the interest rate, but the rest of it is pretty much the same.
Yeah, it's not going to change your life.
Yeah, it's like a
It'll
nice
make your life
yeah.
a little easier, but not, you know, hey, I don't have a more, you know, I don't have any mortgage payment now. You know, life changing situation, whatever.
I like the way you put that, right? Like I like the way you put that. Like it's convenient. It's not nothing.
Mhm.
It'll make your life a little easier, but it's not going to change your life
Right.
right? Like it's not a life changing event when interest rates drop a little bit or higher. But we were talking about crypto a little bit earlier, before we got started. So, what do you guys think of this FTX? This whole, I guess Tom Brady was involved in it. Tom Brady's had an interesting year, right? That guy,
Oh man.
the goat,
Yeah.
He's had an
Look,
interesting year.
he was due to have some a rough time. Not that I'm wishing that on anyone, but like, let's face it, man, homeboy has been at the top, living the literal dream of everyone for like 20 plus years. At some point, you're gonna fall down that mountain, my friend. You're not going to be able to maintain it. So,
Let me ask you this: do you think this is a fall? Right? Like, do you think this is a fall? Because, I mean, at the end of the day, this still is Tom Brady. And so,
well,
I mean,
that's why he's not retiring.
His option is number one, do I go home to my, Tampa penthouse with my supermodel girlfriend or wife, Giselle, most beautiful, one of the most beautiful women in the world?
Yeah.
Or option two, do I go home to my
guy.
penthouse girlfriend, to my penthouse in Tampa with my 6 model girls that are going to be there waiting? I mean, it's not like this is the only, I mean,
he has options.
Yeah, he has plenty of options.
It's like this, look, let's do a baseball analysis for Tom Brady. Tom Brady, for the last 20-some years, pretty much every time he's gone up to the plate has hit a home run.
Yeah.
Now, homeboy is hitting doubles. He's getting singles. He's still getting hits, but he's not jacking it out of the park on every at bat, right? So there's again, he's fallen on. He was at the absolute top of the mountain, and he's just fallen a little bit. It's gonna happen. Look, the reality is, and I'm sorry, but he's not winning the Super Bowl this year. It's not gonna happen.
You don't think so?
His wife left him. Look, he's divorced. He and his wife are getting divorced. He's got he got busted or he's involved in this FTX crypto scam stuff going on. He's not looking as good on the field as he has previously. He's having some struggles. They're really not winning games because of him. They're winning recently, but not because of him. They don't really look like, they're going to make any real movement in the playoffs or what have you, especially relative to what's happening with the rest of the league. I feel for Tom as much as I possibly can feel for someone who's lived that life, which is not much at all. But he's having a rough time, man.
So what do you think about crypto, though? What do you think about this crypto thing? So obviously, crypto's in the tank. And a lot of the crypto exchanges, I guess FTX, one of the crypto exchanges, filed for bankruptcy. But I mean, we were talking about it, right? So at the end of the day, and I think, Robert Kiyosaki, I don't know if you ever guys read, Rich Dad, Poor Dad. He talks about money a lot. And he goes, the origins of money is debt. He's like, in the most literal sense, he's like, money is debt. So when they count the national debt of the country, he's like, it's the stupidest thing in the world, because in the most literal sense, when you have money, you're extending credit out in that it represents debt, whether it's a bank or whether it's, you owe somebody or somebody owes you, it's some sort of exchange. And the problem with crypto is that it's just sort of created, and it's not used as a medium of exchange. It's not debt, right? Like literally the problem is it's not debt. And then there's other things that Bitcoin's going to make it, like Elon Musk recently came out and said Bitcoin or Dogecoin's going to make it. But what do you guys think of crypto?
I am so afraid of it.
We'll go with you, John, first. What?
Right.
I am so afraid of it. I don't know. It's just there's an old Patrice O'Neill clip where he talks about the day he found out that the gold that the U.S. dollar isn't backed by gold anymore, and just realizing how scary that is. That's how I feel on crypto. Of like, wait, so what's it based on? And I think you had mentioned it before though, about that people aren't buying anything with it. That's why. So wait, and that's what kept confusing me is, wait, it's worth all this, but wait, what are people doing with it? What's the like where I understand a stock that's a company that is producing goods, where crypto, like what's it going towards? And I don't know if you guys watch Always Sunny, but when they go back to Frank's company and says, "What do you mean? We make money. That's what we do." What do you mean?
Right?
Yeah. And that's what it felt. It was like, so what's it do? Just makes money? Like and I've been baffled by it.
Well, and so it's interesting. So you say like I've read a lot about there's a book called The Creature from Jekyll Island, and it talks about how the Federal Reserve, why they took it off the gold coin, etc. And it's like the gold standard at some level completely makes sense, right? And at some level doesn't make sense, and I'll explain that in a second. But the basic premise of like your money should be backed by something. And when you look at the U.S. currency, it's backed by the United States. And it's like, what do you have in the United States? Like, well, number one, you have a ton of real estate, right? You have a ton of physical assets. You have a ton of businesses and marketing assets. You have a ton of tech access, of a ton of tech assets. And if you just looked at the entire United States of America as a whole and saying to yourself, like, having a piece of its currency, let's say $1, represents, all of those buildings, all of those people, all of those infrastructure, all of that economy, all those laws that they technically owe you, right? They technically owe you. It was the gold previously, right? It was the gold standard. Now it's just, U.S. standard, right? Backed by Uncle Sam. And so when you print more money at some level, you're creating more assets that are backed by other assets, right? Those assets could be a physical building. Those assets could be intellectual property. Those assets could be a company. I mean, it doesn't really matter. When you look at like the crypto, it's just you're creating it out of nothing, right? It's not backed by a country. Like there's a big difference between.
Let me jump in here because there's 2 points to make, right, and to add on to. So the first is what really is of unofficially, but really is the standard or the backing, the commodity, okay, that supports the U.S. dollar. It's actually petroleum. It's oil. Okay, it's a petrodollar. And the reason for that is because on the international marketplace, if you want to purchase petroleum in the international market, you have to spend U.S. dollars. You can't buy it with any other currency but U.S. dollars. Now, how are we able to enforce that? Okay, just the way that America enforces everything. So this is why the U.S. can borrow so heavily from other countries, and they never call in the debt, because essentially what they're doing is they're creating petrodollars, and the U.S. dollar is backed technically, unofficially, by petroleum. It's a petrodollar. That's why we're so invested in the Middle East. That's why we're always so concerned about what's happening in the oil markets, and that the energy markets have such a massive effect on the economy, not only in the U.S. but also globally. This is also why our people that are lending us money, or the countries that are lending us money that don't like us, continue to lend us money, and we continue to look the other way with certain things that they do that we don't like. It's financial, and it's a petrodollar, and this is also one of the reasons why the United States has been so opposed to moving to alternative fuel sources to provide energy. It's because our dollar is backed by the primary energy resource, which is petroleum. Now it's inevitable.
And they're working on another level too, right? Like when you play the world game, it's a whole different ball game.
Well,
right? Like when you play the world game, like, because to your point, I do think, the United States is the global reserve currency, and there's a lot of commodities that are traded off just the U.S. And then those issues of debt that they're issuing to other countries, some of that's required, right? Like some of that is just good. You got to keep the money moving, right? It's kind of like the same thing of why, a mortgage company doesn't retain all their loans and they sell them off, right? Like, because there's an element of just keeping the money moving that makes sense, especially when you're talking about the sale of goods and from country to country and stuff like that. But yeah, I mean, to your point,
that's an
the oil industry
called the velocity of money, and that's a whole
commodities, all of that is US based. And that's where crypto just, I never got on the crypto train. I never understood it. I'm like, I don't get it. I just don't get it.
Well,
Yeah.
so what the idea behind crypto is that what you're doing is the idea there is, and it's problematic, but the idea being that you create the blockchains which are assigned specifically to that currency, and that's how you can't duplicate that currency. You can only create it. Then once it's created, that's it. It's done. It stays on that blockchain. It's very secure. It can be, and that's all well and good. That's all well and good, and that would be fine. The problem is, and this is John, what we were talking about a little bit before we started recording, which is, of all the crypto that's been created, less than 2% of it and bear in mind, crypto was created under the idea that it will be spent as currency, that this is actual currency, it's money, okay, that it's tangible money that you can spend and you can exchange for goods and services. And actually, quick trivia question. Do you guys know what the first item that was ever bought with crypto was?
Was it a pizza?
Yes, that's right. 2 Papa John's pizzas were exchanged for 10 I think for 10,000 Bitcoin, right? If you can imagine paying 10,000 Bitcoin, even now where it's devalued for 2 pizzas, it's insane, right? And how smart was the guy that said, yeah, no problem, sure, I'll give you a couple pizzas for that worthless currency, right? But the problem is that less than 2% of the crypto that's been issued or that's been created via mining and the blockchains has ever been spent as currency. That's the problem, is that it's not being spent as currency. It's money without velocity. That's no velocity of capital. And you have to have velocity of capital to have a healthy economy. This is also one of the reasons why the US, frankly, has been struggling economically for a number of years. Okay.
Well, it's some level it's a distraction too, right?
Like really rich guy, and they'll explain it to you like this. I'm super rich. I've got a buttload of money. I've got more money than I even know what to do with, right? So what am I going to do? New Year comes around. I'm going to go buy myself a limited edition AMG 63 Mercedes minivan, that they only make 100 of a year. I'm going to go buy one. I'm going to spend 100 grand on that car, right? I'm going to go on a trip. I'm going to spend 20 grand on a vacation. I'm going to go and spend money. I'm going to spend my money to buy all these things. Here's the thing. I can only buy so much. I can only buy so many products or spend so much to buy so many commodities, right? Tangible physical commodities, right? So is it better for me to hoard money that does not go back into the economy, okay? That essentially, if you're looking at the velocity of money as blood coming through the economy, is the circulatory system, where it just blocks and it stops and it no longer functions, it no longer moves, right? That money, when you stop the velocity of money, when you stop capital from transferring, okay, that's where you have economic chaos. That's where you get market crashes. That's where you get a lot of problems, because money has to flow. You have to have capital moving. It has to keep moving. If it doesn't move, it doesn't grow.
Well,
right?
Matt, let me ask you this. What was wrong with, they always talk about the crypto being a replacement of existing currency, right? And that it would be an easier way, wouldn't have the same restrictions, blah, 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 blah. And it's like, got it, understood. But like, I use Zeal, like it's instant. Like I use Cash App, like I send my kids money, like it's instant. What would crypto, I mean, I understand like the non-traceability of that, but that's like, unless you're buying 20 pounds of cocaine from Tijuana, I mean, they're probably not using Bitcoin to do that anyway, right? I mean, it just seems ridiculous to think that is their solution. Like, what is the reason behind all this crypto? Like, what's the purpose? I don't get it. Like, why isn't the money okay? that the governments or that the country put out? Like, why are we arguing with the existence of reality? Explain it. Anybody know that?
I feel like it's the tax shelter, so you don't have to claim it on your taxes. Is the ultimate.
Tax shelter. You can spend it without it being traced or without being asked about it. But John nailed it right there. Taxes. It's essentially. Think of it this way.
But has that actually helped anybody though? Like, is that like
it's the same thing as Zelle, except it's not traceable to be taxed. Okay. It's not traceable to be taxed.
Well, but like, for instance, is that like, I guess what I'm asking is that like actually what has happened? Or is it like, have people avoided paying taxes? Because you sell something on Coinbase and you get a statement from the IRS. It's not like they're gonna, like, Coinbase is reporting your transactions, right? Just like any other brokerage would, right? It's not, or FTX, right? You have an account with them, you buy Bitcoins, you sell it at a profit, like you get, a statement from them for your taxes saying you made this or you sold this. It's not, they don't.
But that's a recent development, and that's a recent development based on legislation passed specific to crypto.
So all these guys, basically what you're saying is all these guys sold this idea, kind of like the student loans, where it's like, you're going to make a bunch of money, just take these loans, like wait till you get out of high college, and you're going to just be overloaded with job applications. And then they do all that, and then nothing happens. The same sort of like, this is going to be our own currency. This is going to be a way for you not to pay taxes. This is a way for you to fly under the radar and purchase all kind of weird shit that you want to online with no repercussions. And then boom, none of that happens.
And then Aunt Sally comes knocking on the door saying, "Hey, where's my money?"
Yeah, none of that happens.
That's exactly it.
That's hilarious.
Kind of nailed it. I mean, that's basically it. Again, it's currency, but less than 2% of it's been spent as currency, and the problem is people are hoarding it. And it makes sense, right? Because you think about it, if you've got, I don't know, let's just say if you got $10,000 sitting in crypto, right? Why would you spend it? If it's an accelerating asset, why would you spend it? It doesn't make any sense. You're going to lose more money. You lose money. And so what happens is, as more people buy in and more people buy in and purchase crypto and get involved in crypto, the demand goes up. It's like anything else. The demand goes up, the value goes up, and it gets to a plateau. And it hits a plateau where people realize, wait a minute, no one's actually spending this as money. No one's spending this as currency. This doesn't actually have any inherent value, okay? And you get guys like the guy that did whatever it was, like Monkey Coin or whatever it was, where he literally created a crypto, took in $1 million, disappeared. Everybody lost their money. No recourse. There's nothing that can be done, because you have to invest actual currency in the crypto if you're buying it, as opposed to mining it. If you're mining it, good luck, right? If you were doing that early on, that would be profitable. But now, forget it. To set up a crypto mine, the cost is not going to outweigh. You're not going to get the return on that investment like you would have 5-10 years ago, right? That boat's already missed. And so what you're doing now, anyone that's buying crypto essentially right now, is pumping up the people who mined it to begin with, or who have the infrastructure to mine it. So it's just that those people are it's a Ponzi scheme. They're pouring their money in to pump that up, and it's just a pyramid scheme.
Well, let's talk about another scheme, the mortgage market.
Until people start spending it as currency and it becomes regulated and accepted internationally as a valid form of currency. The problem is there are so many different types of crypto that's never going to happen. Okay, well, we'll take Bitcoin. Oh, well, that person bought Ethereum. They're screwed, right? Or that person bought Ethereum and they're going to take Ethereum, but that person invested in Dogecoin and it's worthless. So, and how do you know which one's going to come out, right? It's just a literal gamble. I mean, you might as well go to a casino and put money on a roulette wheel, because you don't know which one of those numbers is going to hit that people are going to adopt and say, that's the currency that we want. That's the crypto we're going to use.
Well, and I think people, right? So let's talk about, because it all comes back to the same thing of people trying to make money, right?
Just
And
work hard, people. Just go to work and work your butt off.
and
Make money the
the
old-fashioned.
mortgage market has definitely shifted over the last couple months, right? And it's like at the same time, the crypto bubble burst. I think the refinance bubble bursts for a lot of people. What do you think is going to happen with all these mortgage companies? I mean, are you guys? I'm hearing all sorts of stuff about layoffs and mergers and people struggling to kind of find a way. And I think now you really haven't seen the bloodbath per se that's going to be coming in the next couple months. But what do you guys think is going to happen?
I think, especially like a lot of the hard money lenders, I think they're going to, go by the wayside, if you will. I think like FGMC, I think was one of the first ones.
Yeah.
And it makes sense. I mean, you're lending money that you're taking a big, fucking gamble on people that they're going to keep paying their bills because you looked at 2 years of their bank statements, and when they don't, and a few of those, dry up, you're going to get hit hard. So I think a lot of those are going to, really go away or, downsize, whatever it is. And I think everyone's just going to tighten up, probably require a little higher credit scores, required lower debt to income ratios. And at the end of the day, it does make sense. What I know sometimes like the people can get mad that the documentation that we're requesting, but at the same time it's nothing too crazy. I feel like that that your best friend would want something similar to make sure that if they give you $200,000, $400,000, $500,000, that all right, are you going to keep paying? Because we can only have so many defaults before it all goes to shit.
And
so
it doesn't take many. And the lenders now, I mean, there's a cyclical nature to the real estate business. And like, I always think about, 15 years ago, Countrywide was the largest lender in the country, Wachovia, World Savings, all those names that you kind of, you think
remember,
about.
World Savings was purchased by Wachovia, and that purchase destroyed both of those companies.
Yeah, even like Travelers used to have like a giant mortgage division in a part of Citi. And it's like all those are gone. And it's like all those ones that are gone, I think are largely because of like the refi game. I mean, it's not that much different than like the, we talk about like the Bitcoin bust, where it's like you have a whole bunch of people going after people who, need some short-term fix to their cash flow issue, right? I mean, that's really what it's about on a refi. A short-term fix to a cash flow issue to hopefully save a little bit of money. It doesn't make a difference. Their utility bills are going to be the same. Their taxes are going to be the same. Their insurances are going to be the same. The cost to maintain the house is going to be the same. The house is going to be worth pretty much the same. And then it's all you're doing is, saving a couple $100, right, a month, right? Or maybe, $500-600 a month, which to your point, I like what you told, John, it's like a convenience, but not a life-changing event. And then now, I mean, that's all gone. And if you're not in purchases, I mean, you're pretty much toast. And even now, purchases are kind of tough to do. I mean, most people are taking a pause.
Keep in mind too, guys, that Brian, just something you mentioned there, but keep in mind the ultimate factor that drives the mortgage industry, and it's not something that most consumers are going to be aware of or talk about, is the secondary market.
Yeah.
Okay. It's the ability.
Explain to them explain the secondary market for people who don't understand the secondary market.
Okay. A quick overview is that when a mortgage is originated, okay, specifically when a wholesale mortgage is originated, retail somewhat, but mostly wholesale. So when you originate a wholesale mortgage, what happens is at a certain point that becomes a commodity. That's a commodity, and it's a financial instrument. It's a commodity, and so what happens is that gets sold. as a commodity, as an investment commodity on what we call the back end or the secondary market. Okay. So what you'll have is you'll have investors, hedge funds, banks, right? They'll come in and they will buy the servicing, they'll purchase these loans. So they'll say, okay, well, I want to buy 300 mortgages with this criteria, and they'll give specific criteria, credit score between this and that, buyers with credit scores between this and this, property values between this and this, loan amounts between this and this. They'll provide those criteria. Okay. They'll go out and then they'll find those mortgages that fit that criteria that these servicers will have or the lenders will have. They'll package those as a security and they'll sell them off based on the value of those mortgages being fully repaid. Okay. And or a discount, there's some discounting involved with, but essentially what it is you're looking at that as a financial instrument where, okay, this package of mortgages as a security instrument on average is going to gain me 7%, depending on what the rate is and how these loans are structured. But let's say roughly, that's going to get me 7%. So I'm going to buy those. So they're purchased at a discount, actually. They buy them at a bit of a discount, okay, relative to their value, and then they maintain the servicing and they basically collect the money and they use that as a security. And the thing is that these mortgages can get sold time and time again as securities. So long as it's a profitable security to resell, it's available to resell and it will get resold. And so that's what I'm talking about with the secondary market. And really what happens is if the secondary market says we're not buying loans anymore that meet this criteria, that's where you see a guideline change. So when the secondary market comes out and says, we don't want any loans with an LTV of 100%. No. Well, now you can't borrow 100% anymore. That LTV goes away. Or they say, we only want loans that meet this criteria with a credit score of this or higher. Now, in order to get a mortgage, you have to have a credit score of that or higher. It's not the lenders on the front end that make the determination for mortgage guidelines, for lending guidelines. It's the back end. It's the people that are going to buy these loans as securities, because ultimately they're the ones who are actually taking the full risk in reality. Okay. As long as, and this is part of what happened to crash the market in 2008, specifically Countrywide as an example, okay, where they were writing bad loans. They were just writing crap loans. If you had a mirror and you could fog that mirror, you got a loan, okay? Didn't care, 100%, 110%, fine, whatever, they didn't give a crap. Why? Because there were foreign investors, there were investors who were gonna buy those loans. So they didn't have to service it. They didn't worry about it if it went bad. It wasn't on them. They just sold it off. Okay. Now, obviously, Countrywide did a lot of other things they shouldn't have done, and they overextended. They made a bunch of mistakes, and they ended up costing themselves. But at the end of the day, it's the back end. It's the investors who actually are buying the mortgages as securities who drive the guidelines and make the determinations as to what's going to
you talk about that, right? So there's a good pivot point, right? So thanks for explaining that, Fritz. Is the investors who make the guidelines. And what's crazy is they're not above the hype, right? Like in 2003, 2005, like they got caught up in the hype.
Absolutely. Yeah, of course.
Just like everyone else. And then sort of like to a blind eye. And there are some people, I mean, when you look at Chase, JP Morgan, and what Jamie Dimon was doing, they didn't get caught in any of that. Like he knew what was going on. And he knew he knew the market was going to fall out. He knew there was bad underlying securities. They never did any of those loans. And, they absorbed, who they absorbed? They absorbed Wachovia. And I think Countrywide.
Wells Fargo.
Right? They absorbed Wells Fargo absorbed Wachovia. Bank of America absorbed Countrywide, right?
Yeah. And again, because they and by the way, I will tell you from my experience in the secondary market, Citi they're very active in the secondary market, and they were purchasing loans. Don't get it wrong. I don't want people to get the wrong idea here that somehow, back in the height of the madness, right, between 2005 and 2008, that Citi wasn't writing mortgage loans and they weren't buying mortgages as securities. That's not true. They absolutely were, but they maintained their guidelines and only bought what they would see and know would be a performing asset. So in other words, they would look at it and go, okay, well, that credit score is below 620. We want nothing to do with it. We're not buying it. Or that LTV is over 80%. We want nothing to do with it. We're not buying it. They purchased what they had determined based on historic data had been safe mortgages or safe investments. And when people complain, why do I have to put 20% down? You have to have some skin in the game. You have to have an investment up front in the property that you're financing, right? And what has been historically found is that 20% is a great cutoff, where if people are investing 20% of the value, if they're spending a fifth, they're paying a fifth up front of the value of the asset, they're not going to be as willing to give up on it or walk away from it as or not maintain it as someone else who has less investment would. And so that's
20% is a good number. And it was, they did buy Bank of America about countrywide. It's interesting because the big banks, and you talk about like conspiracies, and I see posts online about like, oh, well, the big banks can't do what I can do as your independent, blah, 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 blah. And it's like, the reality is like the big banks got to dial in. Most of the big banks, like they avoid a lot of the risks. They avoid a lot of the problems. When you look, they fix the issues they have, whether it's
why they're big, and that's why they're still here.
Yeah. No, they definitely can't get ahead of it. Yeah. What do you think, John?
Yeah, I mean, I think the big boys are big boys for a reason. They can set the tone for the market, but at the same time, they don't need to necessarily do those smaller loans because they have more in the pipe coming. To use a baseball analogy, Yankees aren't necessarily worried about the farm system because they'll just get more big bats coming in, and kind of the same thing of like, yeah, we don't need the 620s. Just give us 680s, keep those coming in, and we'll do good with those.
They're large enough and profitable enough. They don't have to fish in the small pond, right?
Mm-hmm.
They're not trying to catch minnows and bluefish. Okay, they're out shark fishing.
Right.
Yeah, and as a business, right? So like, John, you do basically only purchases. We do only purchases. So we've sort of put, when you do purchases only, you sort of put yourself in with the sharks and avoid the kind of minnow refi guys, right? I mean, at some level, right? And as, a real estate company, you're dealing with, you're out there swimming with the sharks every day.
Right.
And, what do you think about lenders who focus on purchases as their primary focus, right? It's tough to do, but like, you almost never see it too. It's super rare, right? Almost never.
Right. Yeah, no. And to me, it makes sense. I think I was saying it before, but like, people are always going to want to buy homes. So to me, it makes sense, and the refinances I like doing. I like doing it for family and friends, obviously. And then repeat clients, when they come back, if they want to do it, cool. I can help you. I know how to do it. They're pretty, they're not it's not a stressful process, but at the same time, I get worried. I don't want to bet my paychecks on the refis going through.
Yeah.
I'd rather, hedge my bet or whatever it is to, people are going to buy homes, and I think that's a smarter route to go. And you can shift the marketing to refinances if you want to do that, if you really want. Same time, it doesn't make a lot of sense when might as well keep the purchases going. Once the pipe's up flowing, you're getting them in, keep it going, keep that momentum. I think that's one of the things that, that any mortgage company should keep them of just keep the momentum going. Don't do any big changes, especially right now. Or the next time the rates drop, don't switch to doing a bunch of refis. It's a good way to go out of business. I feel like. Because
Yeah,
then
but
when
it's
shit
tough.
hits,
I mean, I love it, but it's tough, right? Like at the end of the day, like, doing purchases. I mean, you talk to the people, and you gotta wait 6 months, 3 months, and then you find out they bought a house with somebody else, or whatever. There's somebody who went boo, and they don't want to work
right.
with you anymore. And I think people have problem kind of keeping their energy up, right? Like where it's just like on the real estate side, I mean, you send them homes, you go out and show properties, you get the pre-approval done, the pre-approval expires, and you got to re-up it, and then the rates change, their DTI change, and then they don't have enough money, so they're trying to
They bought a
negotiate.
car.
Yeah, it
Yeah.
becomes just like, oh my God, like how do you make any money in this business, right?
Yeah.
Whereas with refis, I think it's almost instant, but like you definitely have to kind of take a patience pill.
Yeah.
You
Yeah, that's
know,
kind of what I was trying to get to before. I think where with the purchase, you just have to build the pipe,
yeah,
and then it'll
Yeah.
sustain because for every one of the people that drop off, you have a few more coming in. And I think we have it down. It's something like by the time once people are under contract of 10, 6 of them should end up closing. But to get to that 10 that you get a contract on, and whether they die because they shop you, low appraisal, issues with the appraisal as far as the condition, or they opened up a car, or they got a car 2 weeks before closing, and so I think if you can, a few ways I try to fight that is right away from pre-approval, let them know to not do that.
yeah,
Hey, don't make any changes. Keep working 40 hours a week. Don't open any new debt. And then that way, once they are under contract, all right, I've done all I can on my end. I've let you know to not do this. Now, do your fucking part, please. I don't want to be hungry next month. Please do your part and get everything into me, quick so we can get this wrapped up.
great.
But yeah, and same thing to that point, rather than the ones that are quick and easy, you just, get the pipe going and keep, turning them in.
Yeah. I think, excuse me.
To piggyback on that real quick, the other thing too, keep in mind, and speaking to LOs at this point, again, not saying anything that they're not all already aware of, but as a reminder, generally speaking, you're going to get more referral business off of helping someone with a purchase than you are on a refi. At least from my experience, you're going to get a lot more opportunities for referrals on a purchase. The other thing too is you get the opportunity to form better relationships, right? Like if you're an LO and you're in the industry and you're doing a refi, you're dealing directly with the borrower and that's it. If you're doing a purchase, you're dealing with the agent, you're dealing with title. You have other people that are now in the industry who you're now bringing into your orbit and into your network that you can now network with, you can work with, you can gain referrals and get those business relationships and make those relationships that you need to be successful, because you have to have relationships in this industry in order to be successful. You can't be a lone wolf out there on your own, okay, making it happen. It's not going to work. You've got to have people to work with. You've got to have people to count on. You've got to expand your network and market yourself as effectively as you can. In order to do that, you've got to have partners in this business. The way you get the partners, you help them with a purchase, you do your job, you do a great job, you help that realtor close that property. Because again, Brian, what you're saying, where remember that realtor has been working with that borrower for how long? 30 days, 60 days, a year?
Months, years.
Months. Could be,
Yeah,
right. Could be long time. So if you're the LO that's helping them bring that transaction to a conclusion and turn it into a paycheck, you've got a relationship there now that is very, very valuable. And you don't get that from a refi. You get that from a purchase. The next thing you do is, especially in a scenario now where we've got higher rates, you keep in touch with that borrower. Why? 2 reasons. If they're buying a house, there's a good chance that they're going to know someone else who's going to be trying to buy a house. And that's an opportunity, again, for you to get a referral, but also that's an opportunity for you to stay in touch with that client, continue to follow up with them and stay in touch with them, so that when those rates go down, you do have the opportunity to flip that into one of those easy refis, because financially it would make sense for them. And it's not just double dipping, you're legitimately helping that individual, because if they're paying 7%, let's say, or 8% on their purchase, and now all of a sudden you can refi them at 4 or 5%, that's a benefit to that consumer. And now you're really doing your job by helping them do that. And again,
I think you hit it on the head with just the type of loan officer, the type of type of mortgage professional, right? Like somebody who specializes in purchases, who's out there working with agents. I mean, they are accountable to multiple people, right? They're accountable to the buyer, they're accountable to the listing agent, they're accountable to the selling agent, they're accountable to the title company. I mean, it's a pressure situation for you to deliver. And you got to be a pro, right? You're going to miss out on deals, and you're going to screw it up and have somebody tell you, like, I'm never working with you again. You're the crappiest loan officer, or, terrible realtor or whatever to deal with the purchases. Whereas when you're, on a refi, it's just kind of you, the buyer, the borrower, and the appraiser. I mean, that's it. Appraisal comes in, we're good. As long as you have the income docs, etc.
It's always those damn appraisers that cause the problems. Oh,
long fucking assholes. Long term, the purchase market is the place to be. Like, if you're making a career out of real estate, you have to be in the purchase market.
Yeah, absolutely.
Oh, yeah.
Of course. Yeah.
Yeah, and if you can get in good, it just takes a few realtors to have, good working relationships with that, know that they can get a hold of you. And I think, half the battle, to piggyback on your point, is if they can get a hold of you, it really does go a long fucking way. If they know that, if nothing else, he's going to pick up my call, or he's going to text me back, because it is aggravating when, can't get answers from someone. And I mean, that goes a long way to get the referrals. And all you need is a few good realtors that'll give you referrals, and maybe even do some dual marketing, and it really goes a long way.
Well, and let me ask you this, right? So, John, you've been doing this a long time. I've been doing this a while. How do you deal with that burnout of just responsiveness, right? Like, there's a certain point to where, like, you just want to, I do this sometimes where, like, it's 7:00 and I just turn my phone off and I'm like, screw this, right? Like, I'm not calling anybody. Yep. Or on a weekend, you get somebody who calls you and like, hey, when do you want to go see the property? And they're like, oh, let's go see it. Can you do it today? Can you do it like today at 1? And you're like, I could do it, Tuesday. Like, I'm not doing it right now. I'm not
right.
It's Sunday, at 9:30 a.m. I'm not doing it right, later on today. But then at the same time, you miss out on deals. Like, I've had deals to where you miss out because somebody else called it back, or they say you're not being responsive. I try to train my clients to text me. Right. Like, if they call me, I'll be like, hey, I'm in a meeting. Text me real quick, even though maybe I could have taken the call. And then sometimes I think to myself, I'm screwing myself. Just take the call.
Right.
I mean? Like, kind of, how do you balance that?
Yeah. For myself, I let them know on the weekends that I take my kids so my wife can catch up on sleep. With that, but I'll try to slide away, and I let them know, when they take a nap, I'll give you a call or try to respond if but bear with me. I apologize, and I give them a call. And half the time, I end up having to call with I have a 2-year-old on my lap, trying to grab the microphone, so they hear that, and that I'm being truthful. I'm not lying. I got a little monster, and the other thing, just setting it. I wake up pretty early, but I try to make sure I do that on the weekends too, and get any work done I want to get done, before 7, 8 o'clock when they wake up, and that way, hopefully it's not a full day that they'll go without a response, and that is schedule a call. That's the other thing I do like doing. If it's on the weekend, let's schedule a time.
That's a good idea. Yeah, kind of keep
Yeah,
it.
that's the way to go. I mean, to use another sports analogy, keep using these sports analogies. I'm the least athletic guy in the world. I'm using sports analogies. Availability is a requirement for success. If you can't show up, you can't win.
Right.
If you're not making, you can't play. You're not, John, you were a pitcher.
Yeah.
If you couldn't get on the mound, you're not winning that game.
Yeah. What am I doing?
Right?
Yeah.
So.
Yeah.
Almost. Being available is a skill set in itself.
Absolutely. That's the toughest. I think that's really the finest line that has to be walked, right? So John, like, that's a fine line for you to walk between having your own life and doing what you need to do for yourself and your responsibilities to your family and yourself and everything, and then also being available for the clients. That's a really fine line to walk, and that's a tough one. And yeah, probably saying, hey, let's schedule a future time, let's schedule another time, because the other part of it too, listen, Mr. Consumer, right now I've got a 2-year-old sitting on my lap. I'm trying to feed him strained carrots. He's fighting me on this. I would prefer to have an opportunity to speak with you where I can give you my full attention and give you the respect that you deserve to have, rather than splitting it and no one getting what they need from me, right? So let's schedule this, and then you'll have my full attention for that amount of time. And this will also give you lead time so that if you have additional questions or anything else comes up, we can go ahead and address it at that time, right?
Yeah. And I'll do it on their. Yeah, and I think if you do it on their time too, it's like whatever time works for you. Just let me know. I will make myself available. Because then it's a lot easier to ask my wife to help out, and I shouldn't say it like that, but hey, can you take the kids over for
Yeah, I get what you're saying, but I mean, I'm just saying, I think you got a great way to handle it there. I think that's a really good tidbit or a good takeaway for any of the other LOs or folks who are getting into the industry to be an LO. Learn from John on this one, guys. He's a successful guy for a reason. He knows what he's doing, and he's giving you good advice. Pay a bunch of money for an ebook to get this good advice. All you got to do is just listen to what the man is telling you.
This is the man, what the man says. That's funny.
Right.
That's funny. That's funny.